Welcome to the deep dive. This is where we take a whole stack of information articles, research notes, and we really try to pull out the most important bits for you.
Yeah, the key insights.
Exactly. Think of it like your shortcut to being genuinely clued in. We try to pack it with surprising facts, maybe a little humor too.
Keep things interesting.
Right. So today we're diving into the, fascinating and frankly sometimes alarming world of Bitcoin scam cycles.
Wow.
And we're looking specifically at what one expert is calling the biggest scam of the current cycle.
And this deep dive, it's built from some really insightful stuff from Matthew Crowder's Bitcoin University. It's an article that really digs into these historical patterns and connects them to what's happening now in crypto scams.
It sounds like a great source.
It really gives a clear way to look at things, yeah.
Okay, so our mission today is pretty clear. Understand these patterns, learn how to spot the red flags, and arm you with the knowledge you need to navigate this whole evolving Bitcoin and digital asset space more safely. Okay, let's get into it.
Let's do it.
So I think to really get what's happening now, we kind of need to look back first, right?
Absolutely. You can't understand the present without looking at the past cycles. It's crucial.
Yeah, it sets the foundation.
Right.
So where do we start historically?
Well, the first really big wave we need to talk about is the 2017-2018 ICO boom, initial coin offerings.
Oh, yeah, I remember that. It was everywhere.
It really was. And the pitch was usually pretty simple, very tempting. Buy our new coin. It's going to be better than Bitcoin.
Right, faster, newer tech, going to moon, that kind of thing.
Exactly that. Faster, better, newer. And a key example Crowder uses is EOS.
EOS, right. What was special about them again?
Well, they famously raised an incredible amount of money, something like $4 billion.
$4 billion?
Yeah, $4 billion. And this is before they even, built their actual blockchain.
Wow. So people poured billions into just an idea.
Pretty much. Billions for a concept. And the outcome for a lot of the investors, well, it's kind of predictable in hindsight.
Let me guess, the tokens didn't do so well.
You got it. They ended up holding tokens that just tanked in value. Often became pretty much worthless. But, and this is the really key part of the pattern Crowder points out, the people issuing the tokens, they often took the money they raised
and bought Bitcoin.
Bingo. They strategically acquired and held Bitcoin. Block.one, for instance, the EOS guys. They still hold about 164,000 Bitcoin.
Whoa. Okay. What's that worth now?
Last I checked, around $19 billion. Give or take.
So the lesson from that whole ICO boom then?
The core lesson, yeah, is that the promoters got the Bitcoin, the investors. They got left holding these, well, often useless assets.
It's like a bait and switch. Use the hype for a new thing to actually accumulate the established thing.
That's exactly the playbook. Prey on that desire for quick gains while you quietly stack the real store of value.
Okay, so that was the ICO wave, but these things tend to repeat, just in different clothes, right?
Yeah.
What came next?
Well, you'd think people would learn, but the crypto world moves fast. The next big thing was the NFT and rare digital asset craze.
Ah, yes, the NFTs. Digital pictures selling for millions.
Exactly. Non-fungible tokens, inscriptions, these things called rare sats, basically unique digital items tied to the blockchain somehow.
Seemed pretty wild. Lots of money flying around for things that felt intangible.
Definitely. And what's interesting here, Crowder notes, is that even some, established, reputable Bitcoin companies got involved.
Really? Not just new projects?
Nope. Some well-known names were selling things like digital logos or these specific rare items for huge amounts of Bitcoin.
Huh. And the outcome this time? Same story.
Pretty much, yeah. Prices crashed hard eventually. The source even points out how Wikipedia now lists a lot of those once super expensive NFTs as basically worthless by 2024.
So another cycle of hype, crash, and maybe the sellers ended up better off.
It fits the pattern. New promises, amplified returns, but the underlying value capture often flowed back towards Bitcoin or those who collected it.
Okay, so we've seen ICOs promise better than Bitcoin. NFTs promise unique digital value. What does Crowder see as the main risk today, building on this history?
Right, so his current big concern, the focus of the article really, is Bitcoin treasury companies.
Bitcoin treasury companies. Okay, what are those exactly?
So the concept is these are corporations, public companies sometimes, that claim their main business is accumulating lots and lots of Bitcoin.
Accumulating Bitcoin. Okay.
And crucially, they promise their investors superior returns by doing this. They're essentially leveraging that Bitcoin.
Ah, okay. So it's not buy our coin, it's better than Bitcoin. It's buy our stock because we use Bitcoin to outperform Bitcoin.
You've nailed it. That's the shift. It's the old pitch, just repackaged. Invest in our company, and we'll give you amplified Bitcoin exposure. Better returns than just holding BTC yourself.
Sounds appealing, but tricky. How do they actually work? What are the mechanics?
Well, that's where it gets worrying. Many of these companies, Crowder points out, have very little or sometimes no actual business revenue outside of this Bitcoin treasury idea.
So they're not really selling anything or providing a service.
Not in a traditional sense. Often, they operate much more like highly speculative penny stocks.
Right.
Very volatile.
High risk.
Exactly. And there's a big potential for pump and dump schemes, often using something called PIPE deals, private investment in public equities.
PIPE deals. How does that work?
It lets insiders, like early investors or management, get shares really cheap before the stock is widely available or hyped up.
Ah, so they get in lows, potentially pump the price, and then sell to retail investors who come in later at higher prices.
That's the risk, yes.
Yeah.
The article gives a specific example. Nakamoto, ticker NAKA.
Okay, NAKA. What happened there?
So with NAKA, the PIPE investors, the insiders, they managed to get shares for around $1.12 each.
$1.12. Okay.
Then the stock price surged dramatically, went all the way up to $20 a share at one point.
Wow, that's a huge jump. Great for those PIPE investors.
Incredible paper gains, yeah. But for retail investors who bought in near the top, heavy losses followed.
Ouch.
And the source warns there's potential for massive dilution after a merger, like 6,400% dilution.
6,400%. That would crush the share price, wouldn't it?
It could absolutely lead to a complete collapse. And there's an analyst mentioned, Molly Big Magic Dow, who specifically warns about insiders potentially dumping their shares onto, unsuspecting retail buyers.
That is a really stark warning. So this whole strategy of using Bitcoin's brand, basically, Crowder has a name for that, right? Orangewashing.
He does, orangewashing. And it's a really sharp term for what's happening.
What does it mean exactly?
It basically describes how these companies borrow Bitcoin's image, its strong brand, the trust people have in it, the orange logo, even the market schemes that are actually quite risky. And sometimes these schemes are really more fiat-based or just stock plays that don't have much to do with Bitcoin's actual core value.
So it's like putting a Bitcoin sticker on a risky penny stock to make it look safer or more appealing.
That's a great way to put it. You're leveraging the brand without offering the substance or the security.
Is it just like the old altcoin scams then?
Crowder argues it directly mimics that pattern. The old pitch. Buy my altcoin. It's better than BTC.
And the new pitch.
Buy my BTC company stock. It's like amplified BTC.
Whoa.
It just sounds more sophisticated, maybe ties into traditional markets.
But the likely result could be the same.
According to the article, yeah. The prediction is many of these companies might just disappear once the insiders cash out.
Leaving retail investors holding the bag again.
Exactly. Just like the ICOs, just like the NFTs, substantial losses for those who bought into the hype late.
Okay, this is sobering stuff. So for you listening, wanting to be informed, wanting to protect your assets, what's the takeaway? What's the actionable advice from Crowder's analysis here?
Well, his advice is actually very direct, very simple, cuts through all the noise. First, stay humble, stack sats.
Stack sats, meaning just buy and hold Bitcoin itself?
Pretty much. Own Bitcoin directly. Ideally, keep it in cold storage, offline, where you control the keys.
Self-custody. Don't leave it on an exchange or with some third party.
Right. Maintain control. Avoid intermediaries adding layers of risk you might not even understand. Simplicity and security first.
Okay, that makes sense. What else?
Second, he strongly advises avoiding these complex, supercharged Bitcoin products.
The things promising amplified returns.
Exactly. He warns that these instruments often don't really give you better Bitcoin exposure. What they do is shift your exposure into much, much higher risk investments.
So you're trading away Bitcoin's relative security for a gamble, basically.
That's the argument. And it ties into understanding risk versus return. Crowder emphasizes something really important. Bitcoin's historical high returns actually came from its low real risk.
Low real risk, despite the volatility and all the skepticism.
Yeah, low fundamental risk compared to these complex layered products built on top of it. The gains weren't from leverage or fancy financial engineering. They were from Bitcoin's core properties and growing adoption.
So chasing extra returns, adding more leverage or complexity.
Often just means taking on way more actual risk. And the crucial takeaway is taking on that extra risk frequently just leads to losing more money, especially when you're trying to amplify something that's already performed incredibly well on its own.
Don't try to get too clever, basically. Stick to the fundamentals.
That seems to be the core message. True gains came from Bitcoin itself, not tricks built on top of it.
Wow. Okay, this has been a really clarifying deep dive. We've traced the cycles, ICOs, NFTs, now these Bitcoin treasury companies. The patterns seem pretty clear.
They really do repeat.
And Matthew Crowder's message is strong. Maybe direct ownership, self-custody, and avoiding these complex supercharge schemes is the smartest way forward.
It certainly seems like the most prudent path based on this analysis, and it
Yeah.
leaves you with a powerful thought to reflect on.
Yeah.
Well, if history keeps showing us that the people creating these complex, better than Bitcoin, amplified Bitcoin schemes, if they consistently end up holding actual Bitcoin,
While their investors get left with depreciating tokens or stocks.
exactly what does that really tell us about where the genuine long-term value and security actually lies in this whole space?
Mm.
And maybe why do we keep getting drawn to that promise of amplified returns, potentially at the expense of real security?
That is a very powerful question to sit with, something for all of us to think about as we navigate this. Keep learning, keep questioning. Thanks so much for joining us on this deep dive.